If you earned $150,000 last year as a U.S. 1099 worker, the IRS collected over $21,000 in self-employment tax from you alone. But U.S. freelancers using an S-Corp with the exact same income paid closer to $10,000. Same money, same work. $11,000 difference because of one structural choice. Stay until the end, because I'm going to show you the exact math at $80,000, $100,000, and $150,000, and tell you precisely when switching to an S-Corp is worth it, and when it's not. Here's what we're covering today. First, I'll show you exactly how the IRS taxes LLC owners versus S-Corp owners, because most U.S. 1099 workers don't actually understand the difference. Then I'll run the real numbers at 3 specific income levels, so you can see which structure wins at your income. And finally, I'll show you the 3 mistakes most U.S. freelancers make when they try to switch, because getting this wrong triggers an IRS audit faster than almost anything else. This is not general advice. These are real numbers. Let's start. Here's the problem most U.S. 1099 workers don't see until it's too late. When you work a regular job, your employer pays half your Social Security and Medicare taxes. That's about 7.65% of your paycheck, and your boss handles it before you even see the money. But when you're self-employed, you pay both halves, all 15.3%. That's called self-employment tax, and it hits you on top of your regular income tax. Here's the exact math the IRS uses. They don't charge SE tax on your full income. They charge it on 92.35% of your net profit because they give you a small break for the fact that you're paying both sides. So at $80,000 net profit, that's $80,000 times 0.9235, which gives you $73,880. Multiply that by 15.3%. Your self-employment tax bill comes to $11,304. And that's before income tax, before state taxes. Just the SE tax alone. At $100,000, you're paying $14,130 in SE tax. At $150,000, that number is $21,194, just in self-employment tax. Now here's the question. What if there was a legal way to cut that bill almost in half? I'll show you exactly how in a moment. But first you need to understand why most U.S. 1099 workers never even look at this. Most U.S. freelancers start as a sole proprietor or a single-member LLC because it's the easiest setup. And that's fine. But as your income grows, that default structure quietly costs you more and more every single year, and nobody sends you a notice. The IRS never calls to say, hey, you could have paid less. You just keep overpaying until someone tells you to stop. Here's the part most people get wrong, and it's the reason S-Corps work. When you own an S-Corp, the IRS sees you as an employee of your own company. So you pay yourself a salary. And only that salary is subject to payroll taxes, which are Social Security and Medicare. But here's what most freelancers don't know. Any profit your S-Corp earns above your salary can be taken as a distribution. And distributions are not subject to self-employment tax. Let that sink in. You're literally splitting your income into 2 buckets. The salary bucket gets taxed at the full payroll rate. The distribution bucket skips that tax entirely. The IRS allows this. It's written directly into the tax code under IRC Section 1402. This is not a loophole. This is a legal, IRS-approved business structure that millions of small business owners use every single year. But this is critical. The IRS has one rule you cannot ignore. Your salary must be reasonable. That means you have to pay yourself roughly what you'd pay someone else to do your job. You cannot pay yourself $10,000 and take $140,000 as a distribution. The IRS watches this closely and will audit you for it. I'll show you how CPAs typically handle reasonable salary in a moment, because getting this wrong is one of the 3 most expensive mistakes I'll cover at the end. Let's run the numbers. Real numbers, not estimates. Scenario 1. You're making $80,000 as a U.S. 1099 worker. As an LLC, your SE tax is $11,304. As an S-Corp, a reasonable salary at this income level is typically around $42,000. Payroll taxes on that salary, both your share and the company share, run about $6,426. Your remaining $38,000 comes out as a distribution with no SE tax on that portion. Total payroll tax as an S-Corp comes to $6,426. Gross savings versus an LLC, $4,878. But here's where it gets real. Running an S-Corp costs money. You need payroll software, a payroll service, and a CPA to file your 1120S return. That typically runs $2,000 to $3,000 per year. Net savings at $80,000 is roughly $1,878 to $2,378. That's real money, but it's marginal. Whether it's worth the added complexity depends on your state, your CPA costs, and how organized your books are. At $80,000, this is a conversation to have with your CPA, not an automatic yes. Scenario 2. $100,000 net profit. This is where things shift. As an LLC, your SE tax is $14,130. As an S-Corp, a reasonable salary around $50,000. Payroll taxes equal $7,750. Distribution of $50,000 has no SE tax. Gross savings, $6,480, minus S-Corp costs of $2,500 to $3,000. Net savings, $3,480 to $3,980 per year. This is the level where most CPAs say the conversation becomes serious. You're saving nearly $4,000 annually, and that figure compounds every single year you stay in the right structure. Scenario 3. $150,000 net profit. At this level, there's almost no debate. As an LLC, your SE tax is $21,194. As an S-Corp, reasonable salary around $70,000. Payroll taxes equal $10,710. Distribution of $80,000 has no SE tax. Gross savings, $10,484. Minus S-Corp costs. Net savings, $7,484 to $7,984 per year. Every single year. If you stay in LLC from age 35 to 55, earning $150,000 annually, that's a potential $150,000 to $160,000 left on the table over your career. So how do you actually do this? Here's the process. Step 1. Your LLC needs to already exist. If you don't have one, file with your state first. Step 2. File IRS Form 2553, Election by a Small Business Corporation. This is the form that tells the IRS you want S-Corp tax treatment. You generally need to file within 75 days of the start of the tax year you want the election to apply to. Step 3. Set up payroll. You are now an employee of your own company. You need to run actual payroll, withhold taxes, file quarterly payroll returns, and issue yourself a W-2 at year-end. Step 4. Work with a CPA to set your reasonable salary. This is not a DIY calculation. A qualified CPA will look at your industry, your income, and IRS guidance to set a defensible number. This is not a weekend project. But for most freelancers earning over $80,000 to $100,000, the first year's tax savings alone covers the CPA and setup costs, and every year after that is pure savings. Now let's talk about the 3 mistakes I see freelancers make when they try to set up an S-Corp. Each one has a real dollar cost. Mistake 1. Setting an unreasonably low salary. This is the most common one. A freelancer earns $120,000, pays themselves a $15,000 salary, and takes $105,000 as a distribution. They think they're saving money. What they're actually doing is waving a red flag directly at the IRS. The IRS has been auditing S-Corp for low reasonable salary issues for over a decade. If they reclassify your distributions as wages, you owe back payroll taxes, penalties, and interest. We're talking $10,000 to $20,000 in unexpected tax bills, plus the audit itself. The fix: Let a CPA set your salary using Bureau of Labor Statistics wage data for your role. Document it. Keep that documentation. Mistake 2. Missing the Form 2553 deadline. You cannot retroactively elect S-Corp status for a year that's already over, with very limited exceptions for late relief. If you decide in November that you want S-Corp status for the current tax year, it's too late. Miss the deadline and you're paying LLC level SE tax for the entire year you intended to save. At $100,000 income, that's a $3,000 to $4,000 mistake. The fix. Make the election in January, ideally during your first quarter planning session with your CPA. Mistake 3. Skipping quarterly payroll tax deposits. As an S-Corp, you're required to deposit payroll taxes quarterly, not annually. Freelancers used to estimated quarterly taxes sometimes forget that payroll tax deposits have different rules and different deadlines. If you miss them, the IRS charges a failure to deposit penalty of up to 15% of the unpaid amount. On a $70,000 salary, that's up to $10,500 in avoidable penalties. Use a payroll service like Gusto or QuickBooks Payroll. Automate the deposits. Don't manually track this. Here's the bottom line. If you're earning under $80,000 as a US 1099 worker, stay with your LLC for now. The S-Corp savings don't clearly outweigh the costs at that level. If you're at $80,000 to $100,000, have a serious conversation with a CPA this quarter. The math is getting meaningful. If you're over $100,000, and especially over $150,000, and you're still operating as a default LLC, you are likely overpaying the IRS by thousands of dollars every single year. That needs to change. If this video saved you money or is about to, subscribe right now. Every day we break down one tax strategy that keeps more dollars in US 1099 workers' pockets. Drop a comment below and tell me what's your current business structure and income range. I read every single comment and I'll tell you exactly which scenario applies to you. This video is for educational purposes only. The numbers shown are scenario-based calculations and not personalized tax advice. Consult a licensed CPA or tax professional before making any changes to your business structure.